It was a trio of, good news, which I don't think we also anticipated in 2019. We just took a call that at least the credit cycle or the provisioning will come down. At least one of the three is going in your favor, and the remaining two are bonus. In 2025, I think the same thing is repeating, but in a very small way in banks.
In terms of pockets, I know you can't talk about stocks.
So clearly healthcare is one sector in India where there is demand-supply gap. The hospitals earlier used to take 3 years to pay back to get to a 70-80% occupancy. Now it's happening in 1.5 years. Return in an equity stock, any company, gets made when a company is able to reinvest its cash flow. If you look at it in connection to the rest of the market, I think it's not a bad outcome if you get 10-12% earnings growth rate at a valuation which is lower than your previous peaks or lower than your averages or lower than median. It's not a bad place to be.
Hello and welcome to the Wealth Formula. My guest today is the CIO of a leading Indian mutual fund with nearly 2 lakh crore in assets under management. He's had a stellar career. He's been in the markets for last 25 years, seen multiple market cycles. He started off as an analyst on the sell side, went on to lead research for a leading foreign brokerage firm before moving on to the buy side as CIO of the mutual fund. He also started off with the twin qualification, which is almost a guarantee to success in the Indian financial world. He's an IIM. He is a mechanical engineer from IIT Bombay and MBA from IIM Lucknow. None other than Rahul Singh, CIO of Tata Mutual Fund. Rahul, thank you so much for joining me on the show today.
Thank you for inviting me, Mahalakshmi, on this.
Started out with the academic qualification, which in India surely has the maximum odds of success in career, an IIT and IIM. So when you look back, is this all exactly the way you envisaged?
Nothing is exactly the way you envisaged, for sure. And IIT was a very humbling experience because you think you've achieved something and then you go in, suddenly you are in a class with some super brains. So it kind of brings you down to earth immediately. But I think it was very clear at the end of my engineering that I wanted to pursue a slightly more rounded kind of a career rather than engineering per se. So that part was clear. An MBA kind of happened as a default option after that. And from there on, things have taken their course.
I remember meeting you and talking to you, during my times as the Cub reporter. I joined Business Standard in 2000. And I think that time you were with SSKI. You were, yes. Now I think that name is forgotten in a sense on the sell side. But tell me your early years and more importantly, this transition from being an analyst to fund manager. Because, as an analyst, your prime expertise is in modeling, in understanding the sector, in having your network in place to ensure that you know beforehand what is going to happen, what is the all of that. But as a fund manager, there is a different dimension in terms of portfolio management, managing risk and all of that. Tell me about your early years and this transition.
Yeah, so early years, I think I joined sell side after having spent 5 years in CRISIL. So that gave me a strong, ground training, on the ground training in terms of how do you analyze companies, how do you analyze balance sheets, I think, and P&L, because in CRISIL, the main job was to find loopholes and what the company is doing, which they are not really supposed to be doing in terms of the finances. So from there on, the sell side experience was in SSKI, which I think was a great learning ground because it was very entrepreneurial. And from day one, you were thrown in the deep end and you were supposed to figure things out. So it's great because, you're not spoon fed. You're not starting an associate and then becoming an analyst. So you straight away an analyst, and you're supposed to start having a view on a sector, on a company. And
you had one of the toughest sectors. Telecom. It was happening at the same time. Yeah. Super complex that time because technology, GSM, CDMA, all of that regulatory landscape was still evolving.
Yeah, it was super complex. And It went through the IPO of Bharti and then the launch of Reliance, so many regulatory changes
Right.
and back and forth. It was super exciting actually in hindsight. Although at that time it was just too much intensity of news flow and too much of changes which were happening at the same time. Same with oil and gas, which I was covering, because at that time privatization was a big theme, during Vajpayee's government.
Right.
So there was a lot of excitement in oil and gas also. So I saw the full cycle. I saw fear in telecom and then the revival, and then I saw the excitement in oil and gas on privatization and then the disappointment.
Which continues for 25
Which
years.
continues. So I saw very different cycles in those two sectors.
Right.
And if you look back, that was a good learning ground because it also made you hold on to your convictions, whether it's positive or negative, and ride through that storm. And I think SSKI was a good platform which allowed you to do that, and helped you and gave you that platform to take your own call and not really be influenced by anything.
Right.
I think that kind of was the early ground where I think there was a little bit of contrast streak which came into me a little bit at that time, which kind of has stayed after that. And obviously you try to temper it down as you go from sell side to buy side, because in sell side you can take strong views,
Right.
but in buy side you need to measure it in terms of probabilities, right? So you have a strong view, but what if you're wrong? You can't hold your portfolio to hostage,
Right.
if you are wrong completely, especially if it's a large stock, index stock. So I think that moderation, or that how to size your portfolios, even if you have a strong buy kind of on a company or a strong sell view on a company, how do you time it and how do you size it in your portfolio? I think that has been a big transition from sell side to buy side, among many other things.
Okay, I want to ask you 2-3 questions related to what you said. But before that, quickly, like I said, you manage 4 funds: the Business Cycle Fund, the Multi-Asset Fund, Balanced Advantage Fund, and I think one more, right? So across these 4 funds, and if you could just distill in terms of what is your primary approach or investing style, what are the 3-4 things that you really look at which you won't compromise on?
Sure. I think first let me just take a little bit of a step back and tell you about what we do at Tata Mutual Fund, which is basically we have a GARP approach.
Right.
Growth at reasonable price. But it's a very loose term. It can be misused, abused. In GARP, we have defined 3 segments essentially. One is value with triggers, where we look at value but don't buy for the sake of value. If we see some triggers over the next 12-18 months for the valuation to emerge, then we look at that sector or that stock much more seriously. The second segment is earning upgrade cycle, which is basically with the view being there that the maximum returns get made when a company is going through an earning upgrade as well as a valuation re-rating. That's where you create maximum value. And the third is thematic, where you tend to have slightly more relaxed calibration of valuation, but we try taking a long-term call, something like
Right.
electronic manufacturing today. So these are the 3 segments of GARP, but in different funds or different schemes, coming to your question, to your main question, how do you kind of
Apply
these varies. So if it's a business cycle fund, which is the most aggressive fund I manage, it is going to be 80-90%
earnings upgrade.
earning upgrade as well as value with triggers.
Right.
Because I'm trying to identify companies or sectors which are either at the beginning of a cyclical upturn or middle of cyclical upturn, but definitely not at the end of
Right.
a cyclical upside. So there, the proportion of GARP will be, intensity of GARP will be 80-90%. If it is balanced advantage fund, it will be more like 50-50 or 40-60. Because I want to have some stability in the portfolio where you buy companies which may not re-rate but which will give you 10-12% kind of return, and the remaining 50% or 60% or remaining 40% rather, I would buy GARP. candidates. And then there are funds in between. Large cap would be, again, if it's a large cap fund, although I don't manage it, it'll be more like 60-40 or 70-30. If it's a small cap fund, again, it'll be 0-100 or 0-90, because all you want is companies which will re-rate, which will grow faster.
Right.
So horses for courses, essentially. And I think that's a good framework to have, because right now as a mutual fund industry, we are also managing much more assets than we were managing 10 years back.
Yeah.
So we have, there is a responsibility, because we have become a savings kind of a vehicle, and therefore the experience has to be similar to what that category demands, rather than being too much of a style bias, in my view.
True. So if you can give us 2-3 examples of each of these, each of these things, like value with triggers. Tell me 2 or 3 instances how you spotted these triggers.
Let's say 15 years back, 20 years back, there was some information arbitrage which used to be available.
Right.
And you used to get more time to analyze stuff. It was less noisy.
Right.
Now it's more noisy. There is no information is very, very democratic now.
Correct.
So you really have to try and be ahead of the curve in terms of identifying where those value opportunities are, or where those re-rating opportunities are, and you will go wrong in some of those. So when you look at value with triggers, here the starting point is that the stock or the sector or the company has to be available at lower than 10-year average, or at least median or lower than median. That becomes the starting point.
In terms of valuation, in terms of earnings multiple.
Whatever the valuation might be, P, EV, EBITDA, price to book,
right.
Whatever that parameter might be for that sector.
Right.
Now, once you get that, then you try and question yourself, and the analyst question, or the analyst is made to question whether in the next 12 to 18 months, we're not giving 4 or 5 years here, if there in the next 12 to 18 months, are there any visible catalyst triggers, company specific or sector specific, which can lead to a re-rating.
Right.
So one example clearly I can think of is power utilities in 2022-23. Historically lower valuations. The main power utilities, and some going back even 2021. I think the renewable wave was just beginning then.
Right.
So there was a lot of question marks on whether fossil fuel based
will continue or not.
Will continue. Yeah. So there's no terminal value. Oh my God, the terminal value is 0.
Yeah.
So why should these companies trade at more than 8p, 7p, 5p? Why not 4p? I mean,
correct.
There is no limit to think negatively. But I think what was very clear at that point of time is that renewable is not the solution. It cannot be the solution for peak power demand, and fossil fuels will stay. But obviously there is very few believers there, which is why you're getting those stocks at those valuations. So there was a little bit of a structural call on the sector which had to be taken, and those stocks had to be bought. It's a different matter that things played out even better for some of those companies because they also got into renewable, and the power demand went up, if you remember, in fiscal 24. So there was a shortage, and therefore there was a wave of capacity announcements on coal-based, which kind of led to more people to believe what we believed, or what at least some other people in the market believed, and that led to the re-rating from, say, less than 1 time book to 2 times book, from PE of less than 10 times.
And the conversation
times.
Around thermal itself changed because
Completely.
At that time, even NTPC had said that they're not going to invest any more in thermal capacities
Completely.
or coal.
So many companies had said that, and they all took, made a U-turn.
Correct.
Because ultimately, I think everyone was thinking that power demand will also not grow in India.
Right.
But it certainly grew.
Right.
Last year has been slow, but again, what if it grows again at 5-10%?
Right.
If the GDP grows at 7%, and if we are talking about so much of urbanization and demand for ACs, I think it's going to grow. And if it grows at 6-7%, we'll again be scampering for power. And I think that I think was the re-rating for not just the utilities, but it led to re-rating of the capital goods companies, then it led to the transmission, and of course renewable wave was going on. It's not that one led to the downfall of the other. So it was a good kind of a structural call. Similarly, if you look at, I would say, relative value call would be probably healthcare, where I think we had seen a lot of competition coming in diagnostics in 2018-19. A lot of online discounting happened, especially during COVID. And relative to their own history, they were cheap. But we could see that there is a stress, there is a funding winter which is going to come on after 2021 burst. And that led to, competition rationalization.
Right.
And that has led to, not a huge growth bounce back, but, believe that that this is a secular growth story and the valuations have bounced back. So not a huge earnings upgrade, but a valuation upgrade. That is what happens when in some of these cases. If you look at earning upgrade cycle, this is slightly different, which is what happened in banks in 2019, for example, because we were coming after a deep cycle of downgrades,
Right.
where write-offs and bad news after bad news kept on coming. And in 2019, I think all that it was becoming clear that is ending, and you are going to enter into a benign credit cycle. Of course, nobody predicted that the benign credit cycle would be so sharp, but it was clear that it will be benign. So that was a call one had to take on banking, that the earning upgrades will happen. But sometimes what happens in earning upgrades is you start by taking a view that the earning upgrades will be small. But then you get surprised on certain factors which you counted on, which is, NIMs went up simultaneously, credit growth went up simultaneously,
Right.
and the provisions came down.
Right.
It was a trio of, good news, which I don't think we also anticipated in 2019. We just took a call that at least the credit cycle or the provisioning will come down. At
Right.
least one of the three is going in your favor,
Right.
and the remaining two are bonus.
Right.
And then the valuation is at a level where you are, so it becomes very, very easy. In 2025, I think the same thing is repeating, but in a very small way in banks, because I think everyone had assumed that NIMs will decline for
Right.
next 1 year. Now banks are saying that second quarter will be the bottom in NIMs. So obviously the rate transmission on the deposit side has surprised, which everyone was not assuming. So that is something which is also partially playing out.
Right.
What played out in 2019 in credit costs is going to play out in NIMs in 2025. And then, if credit costs surprise, if credit growth picks up, which is a big question mark right now, because that is one thing missing,
Right.
then you have a good combination of, re-rating kind of potential for the sector.
Right. So in terms of earnings upgrades, where do you see possibility of earnings upgrade now? Because I think until the past quarter, I think people were still predicting that, this rest of this year is going to be good. But I think the credit growth is not really giving much confidence in growth. Neither is the consumption pocket. Where do you stand?
So the starting point, Mahalakshmi, for this is that where are the expectations low?
Right.
That has to be the starting point. It is lowest today in consumption.
So expectations not in terms of prices, but in terms of earnings.
In terms of earnings.
Right.
Where the growth has been beaten down and has seen 3 or 4 quarters of successive downgrades, that becomes your starting point for identifying where the earning upgrades could happen. So consumption is definitely one pocket. But
Right.
as you rightly said, it is, as always, it's become a second half story.
Yeah.
Every time we say it will happen in second half. But this
Correct.
time, actually, there's been a multiple, I would say, bazookas which are at work, which is credit, easy liquidity,
Yeah.
lower rates, lower
Tax
income
cuts.
tax,
Yeah.
and banks and NBFCs being encouraged to lend. So I think that the macro is there. The micro has to show results. No early signs as yet, I would say. But generally, I think we have to look there. I mean, from my perspective, we have to look there to find earning upgrade candidates. That's the starting point. Second is cement, for example. It has seen, kind of iffy up and down kind of last 2 years. There's no belief in EBITDA per ton going up. There is competition from, obviously, two large There's been consolidation, but the two large guys are also wanting to take market share. But if you look at the commentary in the last one quarter from some of the large, not part of these two groups, but some of the large cement companies, there seems to be an understanding that the pricing has to be held and the profitability has to be improved.
Right.
And nobody is going to fight for market share beyond a certain sensible competition. So I think that's the starting point for earning upgrades to start. They might get little help from lower commodity prices and all that, but that's a bonus.
Right.
So, and again, valuations are nothing is super cheap today.
Right.
But relative to their own history, one can argue that there is a case to be made there if the earning upgrades happen. So these are a couple of candidates.
So again, just delving slightly deeper on cement. So again, what do you see as the triggers? Only price? Because even demand is growing in single digits, and I think as far as I can see, most people are pinning their hopes on capex being the big driver, like government-led capex being the big driver, not so much the real estate demand. So one is demand driver. Are you really confident that the demand drivers will actually turn out to be, they'll be able to get something at least in higher single digits? So with slight price increases, I don't know whether you can count on that. You're saying prices at least will remain stable. And with today's prices, what is the return expectation?
So if you look at the demand side, you're right that it's not going up like a rocket the way the real estate demand and infrastructure demand was there last 2-3 years. And if you go back in history, when infrastructure cycle was not doing well, when capital goods as a sector was dead, people held cement because it was the safest way as a proxy to so-called infrastructure. Right? A safe proxy to. But somewhere it has got left behind because the actual infrastructure actually did well.
Right.
22 to 24.
Right.
So there has to be some, conceptually speaking, there has to be some bridging of that gap. Demand is not going to be 10% or above. It's going to be 6 to 8%, which is not a bad outcome. And actually, ironically, in cement, a very high demand growth sometimes also fuels competition. So it's very counterintuitive. That you don't
it fuels supply and then you anyway demolish.
Yes, so you don't want that to repeat, and I think the pricing discipline in this 6 to 7-8% kind of growth is much more of a tenable argument as compared to a 10-12%. That is very ironic, but and it's very counterintuitive, as I said.
Right.
But that is how the sector is. So I think if you look at other sectors where they are trading at their 10-year peaks and you compare that with cement, I think there is good re-rating potential. Stocks specific, the upsides vary a lot.
Right.
So I don't want to give numbers here.
Right.
But it's not insignificant.
Be fair to say that earnings in cement will grow in line with demand, which itself is in single digits. And today's prices, can they be justified?
I think it can grow faster than the demand. That's the argument. Otherwise, there is no real case. Although, if you look at it in connection to the rest of the market, where we are looking at 10-12% earnings growth rate in FY26 at best, which is also getting threatened by the way the environment in IT is and so on. I think it's not a bad outcome if you get 10-12% earnings growth rate at a valuation which is lower than your previous peaks or lower than your averages or lower than median. It's not a bad place to be, frankly.
But to get to 12%, you with 6%, 7% demand is like a 5% increase in
That's where the
prices. You think
comes in.
that is possible?
Yeah, I mean the leverage is much more in cement. The upside from EBITDA per ton can outrun the upside from volume growth. That's the nature of the P&L. Okay,
fair enough. Now going back to power, because you spoke about utilities in 2022. 2022, right? Like, how do you size up that opportunity today? Because today the demand environment again is sluggish. You're like much lower than peak demand. So, and the prices are perhaps higher, significantly higher. So there is no comfort there. So how do you look at it? And these are also regulated entities. I mean, there is a cap to what kind of return potential you have, because substantial part of your profits also come from the regulated portfolio. So utilities, if you can break down for us, and then other aspects of power.
So I think in utilities, it's obviously the valuations today compared to what they were in 2022, there is no match. They're all maybe 2 to 3x in terms of price to book. I'm talking about. So from there, the comfort is not there. Earnings growth rate is moderate. So therefore, it's a question of now which narrative you want to stay with. Because it's not that you're going to get a re-rating, significant re-rating from here. So the juice is gone. And there, I think one of the things which is becoming clearer is as renewables grow, transmission as a theme is going to stay much more for much longer than coal or renewables or anything like that. So transmission, power transmission as a segment, which means the utilities, transmission utilities, and then anything below that in terms of suppliers of transmission capital goods, transmission related capital goods. I think that is a solid place to be in, irrespective of the fact that the valuations there also are not cheap. So there is no earning upgrade cycle there. But you would want to be still part of that segment, sub-segment of power. Other than that, it's become very stock specific. If you see something happening in coal-based, and if you get reasonable valuation, then you would go after that. But it's become stock specific. From a segment perspective, that is one segment which is looking decent. The other segment where I think one should be focused more on is the renewable utility space, of which there are not many options available, rather than the renewable suppliers or the equipment suppliers or the solar panels and so on. Because there is a cycle which the industry is going through, which is the peak build cycle, as we call it in any sector. And it will get over in 3 years, 4 years. And then from there on, you will start seeing earning declines. Unless the companies are smart enough, the managements are smart enough to diversify into either backward
other
integrate
areas,
or diversify into related renewable areas. It's not everyone's cup of tea. So there it becomes a call on the management whether you think that management is going to manage that transition.
Right.
But otherwise, stay with transmission utilities, the transmission value chain, and the utilities which are in the renewable space, because some of them are actually trading at a valuation which are lower than the equipment suppliers. I think there are issues. People are worried that some of the PPAs are not getting signed in time and so on.
Right.
But that will affect the equipment guys much more at that valuation than the utility guys. So you really have to pick in the renewable space at the current valuations. If you have to pick, you will pick the utilities and not the equipment suppliers of, say, panels or turbines to the renewable utilities.
So you're saying in renewable utilities, in terms of valuation, is looking attractive, because I did see in your portfolio of cut exposure to NTPC, increased in Adani Energy. So that's what you're saying. So renewable.
Yes, I mean, without getting into stocks, that is the approach we are taking, and transmission utilities, as I mentioned.
Yeah. Power grid also, I saw you've increased exposure. Okay. Completing this point on earnings upgrade, is there any other pocket that you see earnings upgrade in?
Right now,
you said consumption is one area where you could see, because
cement, right now I would say upgrades. Consumption also is on the watch list. It's not that I'm seeing something immediately. I would say.
So what would take for you to start buying, be sure that this upgrade is coming through in the next 12 months?
Unfortunately, unlike cement or IT or banks, where traditionally things move together, like if the macro improves, all the banks improve, and all the IT improves, all the IT companies show a similar trend. It is not the case in consumption. So it is going to be boiling down to brass tacks of identifying which pockets of consumption you really want to go after, whether it's urban discretionary. So first you have to drill down and see the smaller pockets of consumption, because consumption is slowing down, but tourism has done well. Hotels have done well, airlines have done well. So it's really, you have to find that what is that sub pocket of consumption. Quick commerce is doing well.
Yeah.
So you have to find that sub pocket of consumption which is going to do well. So it's not a very uniform thing that okay, one fine day you switch on consumption and you can buy all companies, all stocks. So maybe FMCG is one segment which has seen last 2 years of downgrades only. That's a place to start. I'm not saying it's seeing it, but that's a good place to start. Urban discretionary in terms of retail, not the value retail, but value retail has done well. But the discretionary, urban discretionary, that retail segment which has been seeing a slowdown consistently, except one company actually. So that's another place to kind of look very, very closely. But the point I'm trying to make is it's not one tide will lift all boats. The tide will come in different waves. It's so you have to try and see which is off first. Even in power, for example, that happened. First the coal-based utilities went up, then the capital goods went up, then the renewables went up. So it will always follow in waves. Even in bank, BFSI, that is happening. The large banks are the ones which are holding steady. I mean, the NBFCs and smaller banks would follow.
On the contrary, I saw in your portfolio you have cut stakes in some of the larger banks and picked up 2-3 of the smaller NBFCs and banks. I think RBL you have bought L&T Finance, you've cut HDFC Access Bank. So what is your call? Is there sort of a churn? And that's also seems to be a industry-wide trend that everybody is cutting exposure to the larger private sector banks. And going into smaller names. What's your take? What is the earnings outlook for the next 18 months looking like?
So I think the bigger banks, the issue is that while the valuation was supportive, that one leg of re-rating has happened. So as I mentioned, it's always a question of probability in buy side. Now the probability of a significant upside has reduced in some banks. So you will... in your portfolio, you have to size it accordingly. If you have a 8-9% weightage, if you're bringing it down to 7-7.5%, that's still being
not significant,
positive.
You're saying.
But that's something which you would do and you should do from a risk management perspective. As far as the smaller banks are concerned and NBFCs are concerned, those are right now more bottom up, where we think the valuation was absolutely cheap, or we think the growth is very good. You will only buy either of these two candidates. And that's what we have been doing. Right now, the wave has not really come to the smaller banks where you could blindly buy any smaller bank or buy PSU banks. It's not a widespread kind of a wave which is there today in BFSI, but it is definitely something which is begun. And as it continues, you have to keep finding more and more opportunities for alpha.
Right.
Ultimately the objective is to find alpha when we are doing some of these changes. And as I also mentioned, there are funds which will take higher risk. There are funds which will not take the risk. So some of the names you mentioned, I will hold it in a business cycle fund, but may not hold it in balanced advantage fund.
Right.
Because I'm trying to create more aggressive alpha there, where the risk reward is high. So you also have to see what that portfolio demands or what that category demands in terms of investor expectations.
Right. So if you were, none of these are absolute return funds. But if you were to say, if I were not looking at the index at all, then what are your highest conviction bets right now in terms of pockets? I know you can't talk about stocks.
So clearly healthcare is one. Cement I've already spoken about.
Right.
Healthcare is one because, healthcare is one sector, and let me take 2 minutes here, is one sector in India where there is demand-supply gap. Today, wherever there is demand-supply comes, like in quick commerce, this demand-supply is coming, following like crazy. There is demand for rooftop or solar panels. Suddenly you see, 5 companies.
Yeah.
So in India, supply follows demand like this.
Right.
There is enough capital today. There are enough entrepreneurs there today who will come and rush into that market if there is no entry barrier.
Right.
Or if the gestation period is low. In healthcare today also, I feel that there is demand supply gap in quality healthcare in both in hospitals and diagnostics. Even in hospitals, if since we know a lot of there are a lot of relatives. All of us have relatives
Yeah.
in smaller towns. They still have to travel to the nearest big town for a good treatment.
Right.
If it becomes like something chronic which has to be treated, that just tells you. I have a situation where in state capitals there are no good hospitals, so people have to go to other state capitals. So there is a huge demand supply gap, and that gives you pricing power. Not that you want to extract pricing power in a thing like hospital,
Yeah.
but there is a demand supply gap. The other thing is that you look at 10 years out or 5 years out, the number of people above 55, 60 years of age is only going to grow. I am doing more tests and I'm not getting younger. I am doing more diagnostic tests than I was doing before. I'll be eating more pills than I was eating before. So that also tells you that as a country is fine to talk about demographic dividend and all,
But people are also dying younger. Of course,
Yeah.
that's it's a small number. We shouldn't
So
generalize.
next
but-
5 years you have lot of middle class which will demand these services, and the insurance penetration is going up, health insurance. So therefore affordability is also going up. And this is the class which has earned a lot and is now spending on travel, tourism, and hotels and luxury, etc. Right? This is the same class
Yeah.
which is going to be spending on healthcare. The same class. So you have to be bullish on that. In my view, sector has also seen consolidation. The hospitals earlier used to take 3 years to pay back to get to a 70-80% occupancy. Now it's happening in 1.5 years. There are cases. So that just tells you about the demand supply. So I'm not just making a theme out of thin air. It's actually coming out when the hospitals are expanding greenfield, and it is getting payback much faster, getting occupied much faster. So you can sense it. And I think that's one theme. You may not see too much earning upgrades because some of it is already there in the expectation, but it's a recession-proof industry. It is not dependent on interest rates, not dependent on government policy. Well, hopefully not. And why would you not be bullish on this sector?
No, so my reason for generally being little circumspect about the healthcare industry is the return ratios never look good. Is it because they're constantly in some sort of a capital deployment mode, or is it their ability to charge? It's like, the roads that got built in the past where you could never, those capital costs could never get absorbed. You didn't have enough pricing power to pay for those projects. So in hospitals, while we all say we need better health care, where is the affordability to ensure that those are able to make better returns? And by better returns, I'm saying, if NTPC's regulated return is like 12 to 15% or whatever it is, it should make better than that. Because the multiples that they get are not for those, 12% returns.
Of course not. That is where the changes have happened. You're very right that till 5 years back, if you are in a capex mode, it used to depress your return ratios, and you're always on a treadmill. Now that treadmill is giving you returns also faster. That's the core point which has changed in hospitals. So you have cases where greenfield expansions have generated break even in 1.5 years or 2 years. It used to earlier take 3 to 5 years.
Right.
So the capex, the best return in an equity stock, any company, gets made when a company is able to reinvest its cash flow into a business which generates returns higher than its WACC.
Correct.
Right? Higher than its cost of capital. It happened in telecom in its heydays because I remember Bharti used to put a tower and used to say the payback is 3 quarters.
Right.
3 quarters.
Right.
Obviously, hospitals are not as good, but it has become faster. So you're able to reinvest your capital and generate ROC which is higher, and it's definitely improved. On a steady state basis, the ROCs are up there in high teens, if not 20%. In diagnostics, the ROCs are even superior. they are
Sure.
much higher than that. Multiple.
But how about the competition intensity in diagnostics? How do you see that playing out? You think it is a problem, or will it settle down? What is your take?
It's settled down already. There is always competition because it's very fragmented industry. And it saw competition from the online aggregators during COVID. Also because the funding was very easy, private equity funding and so on. That has dried down. And that has resulted in more sanity in pricing. If you see the pricing changes which have happened after that, there is a gradual kind of a steady inflationary increase in prices. So it's settled down, I would say. Still, the industry needs a lot of consolidation, which is again an opportunity. Because like in hospitals, you have the big brands today. Diagnostics is just scratching the surface, in my view. And you don't want to, these are things where you don't want to compromise. See, education and healthcare, you don't want to compromise on the quality unless it becomes exorbitantly expensive. Right? These are two things in your life which you don't want to compromise on quality. And I think that is where diagnostics have, at least the listed ones, have an edge. And I think as the sector consolidates, as the volume keeps growing organically by 10-15%, it's just an organic growth of 10-15% plus the land grab. So you can grow 15-20% for many years actually.
Okay, so this is more a thematic, longer term play.
It is a thematic, yes.
So this is not a 12, 3-quarter, 4-quarter earnings or re-rating story. These are pockets you would want to buy and play it for
these are
3 to 5
I'm
years.
not counting on them as a earning upgrade candidates. These are more thematic,
re-rating.
Nor re-rating. But if you are getting a non-cyclical 15% CAGR, non-dependent on economic cycles, not dependent on government policy, not dependent on interest rates, not dependent on what's happening with the US or trade war, that 15% is coming with much lower risk.
Right.
And that has a value.
Right.
That has a value. 15% with high risk and 15% with very low risk or devoid of multiple macro risks.
Right.
There is a there is a value for that. I think that's what I am trying to highlight.
Right. I was just trying to see, for example, a Lal Path Labs trades at what? I mean, I think it trades, I'm just seeing right now, I don't have forward estimates, but trailing is like 55 times earnings. So I'm presuming that it might be little, if you have even a 20% growth rate. I mean, is that something that's exciting? Even even if you take a 5-year view, what is the threshold from which you know that you are making at least a 15% return on your invested capital?
See, I think you have to look at it from a relation of the ROC and ROEs also, without getting into the particular stock. As I mentioned, diagnostics are trading at a higher multiple compared to hospitals if you look at EV, EBITDA, or P.
Right.
Purely because the ROE, ROCs are higher. And that also has a value. I mean, why does Hindustan Lever or any FMCG company still trade at such multiples despite going through 2 years of no growth?
Right.
Is because the brand has a value, the ROEs are there, and the cash flows are there. So if you do a discounted cash flow, you will get to P's. I mean, you may not be able to justify it fully, but there is a premium for the brand, etc. And that you have to, and that is why I'm saying these are not re-rating candidates. You cannot claim them to be re-rating candidates. But they'll give you a steady return without giving you sleepless nights on what Trump is going to say,
right,
what government is going to say, what interest rates are going to, whether the economic, whether capex cycle is picking up or not,
right,
whether credit cycle is picking or not, whether SMEs are going to default or not,
right,
whether NPAs or not. Just imagine the kind of noise you're cutting out. Things have to be simpler for you to also sometimes make money. You don't have to make money through a complicated, convoluted route.
Right.
Obviously, that is where alpha also gets created sometimes. But there is a place in the portfolio for such
Sure.
such names.
So if you were to just, think through the sectors and say, where are they in the earnings cycle right now, and where are they in terms of valuation cycle right now? Consumer.
Earnings cycle, hope for a recovery. Valuation cycle, mid to low end.
Valuation cycle mid to low end,
Meaning lower, middle of
Less
their
comfort.
average tenure and maybe little lower than that also in some cases. So
in
which
terms
is
of
why-
historic average.
In terms of the historic average, yes.
Okay. And autos.
Autos valuations mid to the higher end, and earning upgrades, I don't see much actually.
So earnings is peak cycle, you're saying?
Peak cycle, I think upgrade cycle is peaked out. From here on, you will not get upgrades.
Normal growth,
Doesn't mean there's
nominal
no growth,
growth.
but you'll have growth which is there in the numbers will probably come through. But if they don't come through, the valuations are mid to higher cycles, so there is risk if it does not come through. That's the
Capital goods pack.
similar. Valuations actually at the higher end, and upgrade cycle unlikely. Maybe a downgrade cycle can also be there. Probability of a downgrade cycle is also there.
Pharma is quite a diverse pack, so I don't know how you can really say if the sector is which part of the cycle, because it's a lot more bottom up than most of the other sectors. But how do you look at, say, US generics like Cipla, Biocon, Sun Pharma? Those are some of the stocks in
Yeah,
your
I think the
portfolio.
upgrades are over because the sector went through repricing and generic pricing environment was good, and also the all the companies had some good pipeline products.
Right.
Product pipeline, which
Right.
has kind of played out. So now that pipeline has run its course. Now there's nothing new as big as what they had. So there is a little bit of a risk from there. And the generic pricing environment, there's no major improvement from here on. And you have certain key products where which are going off, where the pricing decline is coming, and those are big part of the EBITDA. So I think no upgrades for sure. Downgrades are a possibility, US generics.
Okay, so you're not overweight on pharma.
In fact, within pharma, we are moving more towards healthcare. We have moved more towards healthcare and domestic pharma, and reduced
Okay.
US plays.
Also, okay, going back to your investment journey over the last 20 years, can you pick out like 3-4 anecdotes which sort of gave you some lessons that are like so etched in your psyche now?
Yeah, I think
Any management meetings, any channel checks that you did, or anything that sort of stays with you?
Sure. There's been so many, but let me give you some interesting ones which have more deeper meaning. One is that I had this meeting with a company, one of the first companies I covered in my first sell side job. And I arranged a call with a buy side investor who is very well respected. I won't name him. And during the call, the company kept on saying that, okay, we are focused on ROC and so on and so forth. Obviously, their actions were not showing that, which is why that call was arranged. So this fund manager said that अगर आप ROC ठीक नहीं करेंगे तो मार्केट आपकी ROC ठीक कर देगी. Which kind of stayed with me. Saying that आपका इक्विटी वैल्यू हम इतना कम कर देंगे कि उस पे ROC अच्छा दिखने लगे.
Right.
So it was amazing. That kind of stayed with me.
But that statement will be proven wrong in today's market. Market किसी का ROC कम नहीं
Yeah,
कर.
but company specific, it will still be true. If today a management comes and does those kind of things, which was getting done at that point of time,
Right.
I don't think markets have become so
Not complacent yet, you think?
complacent. No. I think they'll be punished. 100% they'll be punished.
Okay. What else?
The other thing which I did, which I thought was very interesting, again when I was in sell side, is that when in the initial stages of telecom kind of penetration. When there was not much data also used to be there, and people used to get worried that enough growth has happened,
Right.
and now the growth will slow down. I'm talking about 2004,
Right.
2005. I actually went on, me and my associate, we went on multiple local trains in Bombay. One day we just did that. And we counted the number of people who had phones in the first class compartment and in the second class compartment. Just to see that this is the working class. If anyone will own a phone, they will be the first ones to own a phone because they are
Right.
mobile, they need a phone.
Right.
And the data which I remember was even in the first class compartments, I think the penetration that time when we counted was only 10 out of 10%. And in second class compartments, it was just 2 or 3%. So that I think was very interesting and simply done, but thoughtful in the sense that we targeted the right sample to find out actually in Bombay, highest earning population, working population, mobile population, what is the penetration? Just to show that there is plenty of growth. Yeah.
So that was so you were always bullish on Bharti even when the IPO came? Because I remember, I think the
I can
IPO
send you
came
my
at
reports on that.
45. I think the IPO came at $45 or something,
yeah,
right? Like
45, yes.
And even then, it was at 45. It looked super expensive because
then it
people.
halved from
Yeah,
there.
I think it went to 22 or something like that, and then sort of then there was no looking back. So you were bullish right from
I'll
the
have
IPO.
to jog my memory and look at my old reports. Yeah.
Okay. What do you think of telecom now?
Very stable. Again, something like healthcare, you will get your 12-15% growth. Valuations are not super cheap, and they become actually expensive now. But you will get that growth because there is nothing to stop you from doing that. You become like a utility, actually with pricing power also, which they are not utilizing fully.
Yeah.
Because there are only two main players, and one player is dependent on these two players taking a price hike to survive.
Right.
Not
right.
to grow, but just to survive.
Right.
So, what better situation can there be? And people talk about more risk technologically, that something new will come and so on. But those are not very viable options. And I think that's the only potential risk one has to be wary of. That what if something new comes and disrupts the whole terrestrial kind of network? But otherwise, it's a stable.
You see that as what kind of probability will you associate with that?
5%, 10% right now.
That's about it.
Yeah.
That is because the industry is so concentrated.
And also the pricing is quite high for whatever we know of satellite-based services. But it's something to be cognizant of, because typically the biggest risk in telecom has always come from something new, whether it was CDMA, the wireless in local loop, if you remember that time, and then the multiple licenses which were given out in 2008 that started a 10-year down cycle, then entry of Geo, so with a new technology. So always technology has had a major role to play,
right,
in creating disruptions. So one should not discount it, but yeah, it's looking stable.
Okay, so you think Elon Musk will muscle through in this?
I don't
this
think
thing?
anything. I just have to react if that happens. I don't think anything. Those are above my pay grade.
Okay. Any other anecdotes from your experience as a fund manager? Again, from an investment lessons or point of view.
Well, as a fund manager, I think the major learning is also about risk management.
No, tell me some stories, anecdotes.
Stories. I was coming to that.
Okay.
So if you look at when I started my career in the mutual fund industry, and I was managing Balanced Advantage Fund. I think
Which was
in 2018,
right.
2018, 19 is when I started, and somewhere in 2019 there was this tax cut, if you remember the corporate tax cut.
Yeah.
And At that time, I was not very bullish on consumption, and I did not own any MNC companies or FMCG companies because I thought, this valuations. I was a very purist, saying
Right.
that valuations are everything. But obviously, benchmark has those stocks in the portfolio, has those stocks, and I don't have it. Competition has it, and then this event happens, and those stocks go up 15-20%, and you kind of underperform. So that is when you realize that in certain categories, like that was fine to do in some other categories, but not in categories like balanced advantage fund, because investors expect you to have returns equal to the benchmark, if not more, at all points of time.
Right.
So how do you manage the risk even if you're negative on that sector? So today, if I'm negative on consumption, I will not be zero. I'll not be zero on IT, and I will keep assessing probabilistically what are the chances of this sector now stabilizing here and going up, like we were
Right.
talking about consumption.
Right.
Maybe IT will be there 6 months later.
Right.
So I have to keep assessing that. So that anecdote actually helped me kind of come to my senses that I'm no longer in sell side.
Right. 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 Anything else?
Nothing I can think of right now. It's just
Any investor meetings? Any distributor meets, or any ground visits that sort of opened your eyes to some learnings?
I think, well, there are always small things, but I think the distributor meetings and the meeting with the channel partners who actually distribute our products is very, very interesting a lot of time, because you actually get to know how they think, what exactly is their expectation from a category, and also how they chase performance. I think that also sometimes becomes an issue, because the folio experience is sometimes very different from the NAV experience.
Correct.
And I think that's a huge challenge, which I routinely experience with the partners. But the good thing is that the awareness level, or the, let's say, the intelligence level of the distribution channel has gone up significantly in the last 5-7 years. Even in this this period, the kind of questions you get, also a lot of the the online aggregators who distribute our products, they are doing a good job in terms of education on fundamentals. So having these kind of discussions and podcasts, which become a good kind of learning ground for some of these first time investors.
Right.
They will still chase performance, but somewhere down the line, I think it will sort itself out. That's my hope.
Right. Tell me, any point in the last 20 years that you felt really pressurized in terms of work, calls were going wrong in sell side? I mean, were there any periods where you got your calls really wrong? Was there any phase like that, and what was the course correction like?
Sell side course correction is easy.
You can
Buy side course correction is difficult.
It's difficult, yeah. You have to also execute it in
You
your
have to
portfolio.
execute, exit
Yeah.
it, and also make an assessment whether you are you're selling at the bottom,
Yeah.
or you're buying at the peak.
Right.
That fear is always there. When you're course correcting, that fear is always there in buy side. In sell side, you just move on and admit, and I think in a way that's very different. But those points come multiple times in a year. So, and I've been doing this for 25 years, so 25 times
Yeah.
that many multiple times, it's a large number. Let me put it that way. So without getting into specific instances, because there will be multiple such instances. But as I mentioned, in the first part itself, or the first question was to how you've seen the whole cycle. You saw the whole cycle in oil and gas. Saw the whole cycle in telecom. Kind of prepares you mentally for that.
Right.
That's all you can do. You cannot hope that you will not have those multiple points. There will be periods when you will feel that you are super good because all your calls are going right. But that's the time to be most fearful, I've
Right.
realized.
Right.
That's the time to be most fearful because you can't go right all the time. There
Right.
has to be something wrong
Right.
that is going on in the market, and sooner or later it'll come back to haunt you, and that always happens.
Right.
And that when you are like in cricket, when you are in the form of your life, everything even your mistakes, will. But if you're in a bad form, if you
Yeah.
can't hit a simple ball also for four.
Right.
That's the. So you have to make sure that does not happen.
Sure. So you were saying, the past cycles make sure that you're prepared for, deep corrections and stuff like that. Are you prepared for a correction, and in what way?
Nobody's ever prepared for a deep correction. So it's the only way is to keep managing the risk in the portfolio, like I mentioned, and keep making sure that the kind of stocks, the kind of beta, for example, the kind of discussion we were having about finding the right risk rewards, whether
Right.
it's in consumption or cement or healthcare or telecom, where things are a little bit independent of the economic cycle and so
Right.
on. Keep enough of that in the portfolio so that when actually things go haywire, you're not completely caught off guard. But if there are incidents like global financial crisis, or if there is a complete risk off, we have seen that even that does not offer a protection.
Right.
So that's very illogical and it's very indiscriminate. Even a FMCG company will correct as much as probably a capital goods company. So that's the risk, and you can't be prepared. You can't prepare for that. We cannot keep more than certain amount of cash. We are not
Right.
like a PMS.
Right.
So to that extent, you just have to manage within the portfolio, within the constraints.
Rahul, in the world of Indian investing, who are the people you really look up to?
These are the people whom I first serviced as my clients. Prashant Jain and Naren obviously come top of that list. There are many others.
Okay. And your money is all in your funds or in other mutual funds, in other, in stocks? Where have you put your money?
My money is mostly in my funds and other mutual funds, and because of the SEBI rule, also certain part goes to my funds, so that continues. Yeah, so mostly, almost all in mutual funds only.
Okay, cool. Wonderful talking to you, Rahul. Thank you so much for your time.
Thank you, Mahalakshmi. It was a pleasure.